going to be a reliable prospect. The central challenge is a major reform of fiscal policy. And I say this with full recognition of the great complexity of doing so, broadly speaking, a political economy complexity of doing so, but also recognition of the fact that there isn't much alternative solution. First, to make no mistake about it, during this pandemic, the urgent need is still for a significant step up on the part of fiscal policy, not just for purposes of demand stimulation, but because there are urgent public health needs, there's an urgent need to save jobs, and there's an urgent need to stave off bankruptcies on a mass scale. And it does also amount to demand stimulus. But let's make no mistake about that. That's absolutely sensible economics and politics. But we should start thinking, particularly as we emerge now from the first phase of COVID-19, we should start thinking hard about the way we evolve from crisis interventions towards fiscal policy design that still serves some of the crisis needs, but is already prefiguring or anticipating the types of reforms that we're going to need so that this is sustainable. And we need sustainable in the sense that we need a fiscal policy for the future that's going to be able to gradually bring debt to GDP ratios down, at the very least stabilize it, but I'll say you really need to bring it down in a large part of the global economy. And we've got to do it in a way that's acceptable to populations that are now feeling far more anxious, that are now much more dissatisfied with the ordering of things and the distribution of income, and are not going to accept some traditional solutions very easily. But I think that this nature of challenge is an opportunity. It's an opportunity for us to re-gear fiscal policy so as to be able to dispel secular stagnation. It's an opportunity to re-gear fiscal policy to address inequality far more fundamentally. And it's an opportunity for us to address the obviously looming challenge of climate change. How do we do it in a way that's progressive and yet sustainable? And I think far too much thinking, and I've spent a fair bit of my professional and political life on fiscal policy, far too much thinking on the broad progressive range of views is not focused on sustainability. And far too much thinking on the conservative side of the bench is not focused on the need for sustainability in terms of fairness, because nothing's going to be sustainable if it's not fair, and it's not going to be accepted by populations. And there is a real opportunity now, I think, to recenter both the progressive thinking and the sort of sensible conservative thinking around fiscal policy. And I'm running out of time, but I'll just highlight 4 issues very briefly. First, we need to refocus on public goods. There's been a decades-long shift away from spending on public. If you do an analysis of most public budgets, especially in the advanced world, in the 60s and 70s, public goods were a very large part of budgets. If you look at today's budgets, transfers to individuals or families have more or less substituted for public goods. And I think it has to be a progressive agenda to invest in public goods. And I can think of many areas of public goods which are grossly underinvested. Obviously, in the emerging world, in healthcare and education, I would say in a large part of the advanced world, including the country you're sitting in today, education is in a very sorry state and also requires reinvestment. I would say that the traditional focus on R&D and innovation has to be central and helps not just big players, but it helps an SME sector. I mean, if you think of 5G, for instance, or 6G, it's a major lift for the SME sector. And climate adaptation is going to require a lot of money. More broadly, I would say, infrastructure is in a aging state across large parts of the advanced world, and it's in a completely unfinished state, or it's, we are grossly underinvested in infrastructure in the emerging world. How do we finance that on public balance sheets that don't have much space? I think this is an opportunity for a serious rethinking of public-private partnerships. And I say this not by way of jargon, but because I've seen new forms of partnership that are actually durable, that impose a certain discipline on the part of the public sector, including local authorities, and give the private sector not exorbitant rates of return, but decent rates of return. But it means that, be it a local government or federal authority, or a multilateral authority, or bilateral aid, we've got to refocus away from extending loans, grants, and the like on our balance sheets towards risk mitigation. We've got to de-risk infrastructure, most especially in the emerging world, but also in a good part of the advanced world, where you've got to provide predictability of revenues. The opportunity to tap on private finance for public goods seems to me to be a major opportunity and is doable. Second, revenues. And it's not written as much about because it's a painful task. I see no solution that does not involve a significant increase in wealth taxes in some form. The economists will agree that that's the least inefficient tax. It also happens to serve a good purpose when it comes to tempering inequalities. But we have to confront the issue of indirect taxes, because there's no arithmetic that's going to produce enough revenues for the expenditures we need and to bring debts down as a percentage of GDP without serious indirect taxes. And that has to involve either progressive VAT type regimes, and there are such designs. It has to involve, to my mind, at least amongst reasonably serious people, a carbon tax. And it has to involve eliminating fossil fuel subsidies, which are in a sense also tax credits. It'll also have to involve getting rid of tax loopholes, which across the world are quite a substantial business, both domestic as well as international. So if you think of that combination of reinvesting in public goods, thinking of those investments in terms of how do we attract private financing by mitigating risk, using the public balance sheet to mitigate risk rather than to extend itself, and how do we raise revenues through broad-based taxes, not just taxes on the rich, which need to be done, but it's not going to yield that much because there are not enough of them around. But you need broad-based taxes that are designed so that they're sufficiently progressive, and there are such mechanisms. And finally, healthcare reform, healthcare financing reform, which is obviously a particularly acute issue in the case of the US, but it applies also to several other countries. To put it very pointedly, and this has nothing to do with Singapore, but I use it just as an example, but the US spends about 4 times as much on healthcare than Singapore does, but with measurably inferior outcomes. Now, that's not a story about anything great Singapore is doing, but it does suggest substantial savings that are possible through better design of healthcare and in a way that can deliver equitable outcomes. So I'm going to stop there because I've exceeded my time, but I just want to say that we don't focus enough on the design of fiscal policy. It's a separate issue from aggregate demand management, but it's going to be a fundamental issue for the medium to long term.
Thank you very much, Tharman. That is actually, you can see it's an ambitious set of things that we need to do in a world where we have less fiscal room. So it does add to the challenge. And thank you again. I know that you may need to step off this at any point to attend to your other duties. Very much appreciate you coming on such a busy day in Singapore. Augustine, turning next to you, and the global perspective that you have at the Bank for International Settlements, how would you assess the response so far of central banks to the crisis, and what do you think the challenges are going forward?
Well, thank you very much, Andrew. It's always a pleasure to be in any function of the Yale program on financial stability. I got used to have a pseudo summer camp in Yale with you, and I really regret that this year was not possible. So I'm looking forward.
Next year, we'll be back next year.
Yeah, absolutely. We will be there for sure. Of course, the central banks have been at the forefront of the response. Crisis management, in a way, is part of the job description of central banks. I think to start this discussion, what is important is to characterize the nature of crisis that we are facing. A difference of other crises, this doesn't have its origin in the financial sector, banking sector, even macro management. It certainly responds more than anything to the containment measures of the virus. No? And as such, it has generated very particular characteristics. One, given that this has been a global problem, it has generated a global sudden stop in activity, in spending, in financing, in many different aspects, making this a very unique type of crisis. And the other thing that generates a huge difficulty in designing the policy response is that there is a lot of uncertainty on how the underlying fundamental engine of the crisis will evolve through time. Of course, the central bank response has been swift, has been bold, has been impressive. And I think more than anything, to take care of some financial stability issues, and of course, to try to help mitigate the damage on economic activity, but with a lot of uncertainty as we go forward. I think one of the key aspects is just to prevent the immediate impact of the containment measures to generate a financial crisis, and that by itself augment the severity of the crisis of the problem. One very important aspect of all of this is that as through precisely containment and distancing measures, we try to flatten the curve of the epidemic. Another important aspect is to flatten the curve of mortality of firms, that in the absence of some support, this would happen. It could generate long-term scars and make a very serious damage to economic policy making. So with a lot of uncertainty, central banks reacted, as I mentioned already, boldly, swiftly, learning a lot of what had been done in other crises. The immediate objective was to assure tradability in some key markets, in government securities markets, in some money markets, in some private corporate debt, providing liquidity in many aspects, performing as market makers of last resort. And again, this with the objective of short-circuiting the severity of the crisis. The other important aspect is to provide backstops to some credit, and more than anything to some programs that have had the underlying objective to reach the last mile, which is to reach firms and households so that they don't die in the process, and the capacity of the economy to rebound is preserved, and also to generate easy monetary conditions. And in a way, in some latitudes, this is tied to the need also to make it easier for governments to ramp up fiscal spending and have fiscal policy who should be carrying the bulk of the weight in this crisis response, to be able to ramp up the indebtedness without so much hardship. Now, all of these represent some challenges into the future, and I will get to them in a few minutes. But meanwhile, I have to say that the policy response, at least with respect to the most immediate impact, has been very favorable. Markets have been operating like normal. Many, especially key markets like the treasury markets, government securities markets, some key credit spreads have been adjusting. credit intermediation has continued. And we are starting to see some rebound in economic activity, but still with a lot of uncertainty. And we have seen this in the last couple of days. In a way, many markets just mimic what is going on with respect to the evolution of the pandemic. It's worthwhile to notice that precisely given the nature of this crisis, central banks had to go into or have ventured into areas that traditionally they hadn't gone, like into the non-bank part of the financial system, has some crossed some red lines in terms of providing credit, some corporate financing in some cases, in others facilitating a lot fiscal financing. And these are issues that I think need to be taken into account as we move into the future. Now, there are some risks that I see, and then there are some challenges. Two immediate risks that for me are important, at least looking at it. I guess three risks. One of the risk is obviously there, is that the dynamic of this crisis is completely exogenous and cannot be affected by monetary policy or actions of the central banks, which is the evolution of the virus. But other than that, I think there are two that for me are worthwhile mentioning. One is that and it's something very difficult to handle. Financial markets may have become too complacent and have been running probably too fast, especially in the light of all this uncertainty with respect to the evolution of GDP, which at the end is what really matters. We are in the process of going from a liquidity phase in this crisis. Hopefully that has been contained. But afterwards, as unavoidably some of the support will have to give, we will move more into more solvency issues. There will be some insolvencies, and given the extent of central bank involvement, that might represent some issues because traditionally central banks do not take credit risk. They lend, they don't take credit risk, they don't spend, as Chairman Powell has said. In some cases, this has been anticipated by the fact that some indemnities have been granted, also by the fact that a lot of the accompaniment of fiscal policy with monetary policy has come in the front of credit guarantees. But still, this can subject the central banks to a debate of what happens with some of the losses that might be incurred after the very aggressive incursion into the non-financial markets. And given that my origin is in emerging markets, I also have a soft spot for them, and regretfully, they are facing some tough times. The underlying conditions are far more difficult. The trade-offs are starker than the advanced economies have. Health infrastructure is not there. They have very large informal markets, and that makes it even more difficult for them to reach different firms, small, medium-sized enterprises, households. And of course, they face far more stricter financing conditions. No, the access to external credit is more complex. They have been facing tremendous runs because also they have faced very sudden stops, not only in expenditure income, but also in financing, and a lot of reallocation of investments from local sovereign debt markets to safe havens. There is a challenge if there will be sufficient resources out there to help emerging and developing countries to face this crisis. Now, what are the challenges that I fear in the future? And that is to face many of the trade-offs that will start appearing. No? Tarman already mentioned one, which is the issue of fiscal policy. Obviously, very important impact in the economy in the short term, but then there is the issue of sustainability in the longer term. Monetary policy, we also face the same type of intertemporal trade-offs, and they need to be considered. There is a perennial concern about support to the economy in the short term versus financial stability risks in the long term. Of course, in the short term, there is no other way to do it than to face them. But as this moves forward and the accommodation will continue to be there, the financial stability risks will have to be minded. In addition, there is also this very close relationship between fiscal and monetary policy. The very hands-off approach that existed in the past have become far cozier. I mean, again, this has been appropriate, but as this thing progresses, at some point, and especially when hopefully at some point inflation comes, central banks will have to show their independence. I think so far this crossing of some red lines have been done very carefully, having the right narrative. I think all of them are in the context of the central banks being under control because they're justified by the compliance of its mandate, which part of very important one is financial stability, is employment. But at the end of the day, at some point, they will have to exercise their mandates and more than anything, keep at bay the perception and even in some cases the potential reality of some fiscal dominance. For emerging markets, again, this cozy relationship between fiscal and monetary policies is far more adventurous. As one colleague of mine of emerging markets said, doing this type of cozy relationship is like swimming with crocodiles. This was expressed by Lesetja Kanya from South Africa, and I think he described it very well. So I think this is a major challenge that central banks face as we move forward. I already mentioned this also aspect of solvency versus liquidity support. That also will become more difficult, in particular, as this thing drags on. In terms of macroprudential policies, and the combination of microprudential and macroprudential, I would like to make just two comments. One is, again, it has been said that the banking system has been part of the solution in this case, at least so far. I strongly believe in that. I think what has been done was done after the GFC has proven to be adequate and accurate. Now, of course, given that this pandemic is continuing and that it might have some issues in terms of solvency, some of the buffers that have been being used, they might be eroded. So that also will bring into the fore the discussion of the speed at which we want those buffers to be built up. And that brings us to the discussion of dividend payments, buybacks, and so on and so forth. And I think that there we need to be very careful in terms of preserving loss absorption capacity of banks, and in addition also to preserve some capacity for them to in a way support the recovery. Stress tests can be very important in this context, but I think this is a key discussion. And the other is a reflection about the non-bank financial system. In a little bit more than 1 decade, major central bank intervention has been needed to sort of basically avoid the major systemic risk generated in money market funds. And therefore, I think in other aspects of the non-financial system, a lot of financial intermediation has been done in the non-bank financial system. And I think that that is an area where more regulation needs to take place at the global level. So bringing all this and sort of wrapping up my commentary, again, I think that central banks have acted promptly, boldly. A lot of what had been designed in the past and done in the past has been extremely helpful. I think they really managed to take the leadership, making a very quick diagnosis about the consequences of all this. But needless to say, some risks, important risks that remain into the future, and this will give us a lot of thinking to do as we move forward. So I stop here. Thank you very much.
Thanks very much, Augustin. And that's a great global perspective that can lead into a specific question about a specific central bank. And this is a question for Ben. So how do you see the actions taken by the Federal Reserve in this crisis as compared to the types of things that were done under your watch during the global financial crisis? And does the toolbox that they have now seem different than the one that was available to you 10 to 12 years ago?
Well, thank you, Andrew. So the toolbox of the Fed and other central banks has changed radically since before the financial crisis. During the global financial crisis, we at the Fed, out of necessity, had to innovate on various dimensions, including monetary policy and also financial stability policy. The Powell Fed has built on those innovations and added new things to address the pandemic crisis. I'd like to talk a bit about non-monetary policy, outside of monetary policy type interventions, and just say a few words at the end about monetary policy. So on non-monetary policy interventions, in the global financial crisis, the bulk of our non-monetary response was based on classic lender of last resort principles, BADGET, lend freely at a penalty rate to solvent institutions, the idea being to try to provide sufficient liquidity to the system to prevent fire sales and constriction of credit. And our main concern at the time was the fact that the Fed was set up to lend to banks, but the liquidity crisis was taking place across the financial system. And so we had to innovate with things like the primary dealer credit facility, the money market facility, and so on. Now, the liquidity issues are not so central, at least so far, in the pandemic crisis. The Fed this time has essentially replicated our playbook. They've eased the terms on the discount window. They've reintroduced the primary dealer credit facility and the money market facility. They've added a facility to take payroll protection program loans off of banks, but classic lender of last resort activities, again, very much like we did. As we did, I think the most important thing they've done in this category is the international currency swaps. Exactly as we did, they have done currency swaps, swapping dollars to 14 other central banks, I think the same 14 central banks that we did. And that's been very important because banks, foreign banks, or subsidiaries of foreign banks operating in the United States have been short dollars, both because of loss of deposits, but also because their customers have been pulling down their credit lines. And so they're having liquidity shortages in some foreign banks. And the swap lines have been extensively utilized, and they have been an important source of liquidity. The total activity in this lender of last resort category by the Powell Fed has been about 400 billion, at least as of last week. So significant, but not in the same level as 2008 for obvious reasons. It's not been as central to the crisis. But there are two other types of non-monetary interventions that the Powell Fed has done where they've gone well beyond what we did in 2008. The first of these additional interventions is what I call market maker of last resort. The idea here is situations in key financial markets where capital or other constraints, regulatory constraints, are preventing adequate market making or arbitrage. And that's creating disruption in those markets. And the Fed is intervening to try to make those markets function normally. We saw that initially last September when the repo market was in disarray due to a shortage of liquidity. The Fed has since then been doing large term repo operations to provide liquidity to the repo market and to calm that down. And again, the reason they're doing that presumably is because banks and other normal liquidity suppliers have not been able to take up that slack, perhaps because of capital constraints or other restrictions. So that was the Fed's intervention in September. Much more significantly, in March of this year, there was a kind of a crisis in the Treasury market, in the MBS market, in the corporate debt market, associated with a large deleveraging and flight to liquidity, as people became very concerned, obviously, about the economic effects of the pandemic. The Fed did and continued to do large purchases of Treasuries and MBS to stand as a market maker of last resort to help restore normal functioning to those markets. So I think after this crisis, we're going to have to look at the microstructure of these markets and ask whether they're, as Daryl Duffy has suggested, for example, whether we need to have different arrangements for market making in these critical markets. But the Fed, again, serving as market maker of last resort, has directly intervened to try to calm these critical markets, and they were successful. The spike in risk aversion in March of this year has mostly gone away, and the concerns now are primarily sectoral rather than aggregate in the economy. The second additional type of non-monetary intervention I would call, and Augustine talked about this, a non-financial lender of last resort, or a credit backstop. And here, as opposed to the classical budget type lending, this is lending to the non-financial sector. It has a similar spirit in the sense that it's trying to avoid equilibria where people don't lend because they're afraid other people won't lend, that people have lost confidence, there's not enough risk capacity to make normal loans in the private sector. The government sector steps in as a backstop that restores confidence and may allow the private sector lending to resume. The classic example of this is Mario Draghi's outright monetary transactions. After he said that he would do whatever it takes in July of 2012 and created this facility to buy sovereign debt, they actually never bought any sovereign debt. It was successful strictly because markets were told that the government was going to provide a backstop. The same thing has happened here in the US case, where the Fed's interventions in the corporate bond market, for example, have significantly restored normal spreads and normal behavior in those markets without the Fed actually having to buy very much. And so it's important that we not judge the success of, say, the corporate bond facility by how many bonds they buy, but rather how normally the market responds. Now there, I would just to claim a little bit of originality. This was built on things that we did in 2008. We did do the commercial paper facility, we did the asset-backed securities facility, but they clearly have taken this to a much larger level with the backing of Congress and the Treasury to provide the equity so that they don't have to worry about the requirements of the 13.3 emergency lending provisions that require that the Fed not lose money, basically, in expectation on these loans. The one facility which doesn't, it's a little different from the others, is this Main Street facility, which is intended to make loans to medium-sized firms through the banking system. The banks make the loans, the Fed provides cheap financing and takes a 95% participation in the loan to take it off the balance sheet. These are obviously not publicly traded loans, so some of these same considerations don't apply. It may be important for the Fed actually to see some lending, and there may be some need for adjustment to get banks and borrowers comfortable with participating in this program. So again, lender of last resort activity, classic budget response, very similar to the 2008 response, smaller scale because it's not as big an issue this time, but two additional types of interventions: market maker of last resort, stabilizing Treasury and MBS and corporate bond markets, and non-financial lender of last resort, standing ready with Treasury support to overcome breakdowns in normal credit provision due to the enormous uncertainty and risk of the pandemic. Now, an interesting question is to what extent will these non-monetary tools at some point complement monetary policy? We're already seeing this in Europe and in other countries where credit targeted long-term refinancing operations, for example, in Europe, or lending facilities in the UK are essentially quasi-fiscal monetary policies, which are supporting monetary policy. I think that we're not going to see that to the same extent in the US because of the more restricted legal environment, unless Congress decides that it wants to support or change the rules. But on the current rules, without the congressional appropriation in particular, the Fed can't use these facilities on a large scale without congressional support and appropriation. Let me say just very few words about monetary policy. The Fed obviously has eased policy significantly. It's cut rates to zero. Jay Powell says they're not even thinking about raising rates. So clearly there's an implicit commitment to keep rates low for some time. There's been a lot of asset purchases which were intended for market making purposes, but obviously will be essentially associated with a QE program at some point. I think though that at this point, the Fed feels like there's not enough visibility, that until we have greater clarity about the outlook and how the pandemic is going to evolve, that it's premature to give very precise guidance about exactly how monetary policy will be structured. But what I can say about it at this point is that the toolbox at the first level is going to be the same as post GFC. As the Fed has confirmed in their review, their two primary tools will be quantitative easing, beyond rate cuts, will be quantitative easing and forward guidance. But there are some possible tweaks that could happen. Two in particular. One is the review might suggest that forward guidance will be will incorporate so-called makeup policies or overshooting policies, whereby the Fed will say, you know, we're not going to raise rates until inflation is very close to target in some way, allowing for the possibility of modest overshoot or average inflation targeting. So that a change in communication may come out of this review that would allow for some more symmetric approach to hitting the target, and that would be stimulative. The other thing which has been talked about and which may happen, depending on whether it's needed, is yield curve control, where the Fed, by promising to keep rates, by pegging rates at the 2 to 3 year horizon at a low level, by standing ready to buy securities at that rate, would reinforce the forward guidance that otherwise would be purely verbal. So I think there are some changes we may see in the way the monetary policy is executed, but the basic tools would be presumably similar to that we've seen in the Fed and other central banks over the last decade. In any case, again, Alan Greenspan of 1995 would not recognize a lot of what the Fed is doing. I haven't spoken to him recently. I don't know if he's aghast or not, but clearly there have been some significant changes in the role of the central bank and the way monetary policy is conducted as well. Thanks.
Thank you very much, Ben. I can say that forward guidance might be getting extremely complicated if now we have to start to say that we are now thinking about raising rates.
That's right.
Now thinking about raising rates at many, many levels. That we've heard now from several of our panelists about some topics that I'd like to drill down a little bit more now with you, Janet. The first is just how you think the banks are doing. And then the second is we've heard about non-bank financial intermediation or shadow banking, and you've spoken quite forcefully in the past about gaps that remained in the regulatory structure in that area. And I was wondering how you think the last few months have illustrated those gaps, whether your thinking has changed at all. So two things, banks and non-banks, very small set of topics for you.
Thanks so much for those questions, Andrew. And I'm going to pick up and elaborate on a few of the things that Augustine mentioned in his remarks. I'll start with the performance of banks, and I agree with Augustine. They've handled the stress as well. I'd add that payment and clearing systems have also handled the stress as well. With respect to banks, we haven't seen any major bank come under significant pressure. Although perhaps I should say not yet. That reflects, as Augustine emphasized, more than a decade of efforts to make the banking system more resilient through requiring more and better quality capital, liquidity, and stress testing. And for the financial market utilities, we also put in place higher risk management standards as well. And these reforms look to have worked. Banks have seen huge drawdowns on outstanding lines of credit. They've been able to meet those credit needs. They appear to be working with customers under stress. It's hard to know how well they're meeting the credit needs of the economy overall because the risks are unusually large at this point, and banks obviously don't want to make loans that will go bad. But at this point, banks don't appear to be shrinking their balance sheets to preserve capital. I am concerned, though, about bank capital going forward. The largest banks in the United States voluntarily ceased stock buybacks in March. They were required to cease them by the Fed when the stress tests were completed a couple of weeks ago. But the banks continued to pay dividends, and the Fed didn't step in to halt that. And it's something, I agree with Augustine on this. I think it's something that would definitely have been advisable given the magnitude of the shock. Permissible dividends are now based on backward-looking earnings, even though the pandemic analysis in the stress tests showed that if there is a second wave of the pandemic or a long and difficult recovery, the banks are going to experience severe capital pressure. The Fed also based its stress capital buffer requirement on an outdated pre-pandemic scenario. But the preliminary stress test results show that a quarter of banks could fall below minimum capital levels if the downturn is severe. The stresses embedded in the severely adverse scenario, which was the baseline of the stress test, are actually comparable to those in the most optimistic of three pandemic scenarios, the one that assumes a V-shaped recovery. So given that we're not likely to see a V-shaped recovery, so the actual economic path is likely to be worse than the severely adverse scenario, I think allowing banks to deplete capital reflects a failure to learn the lessons from 2008, when regulators allowed the largest banks to continue paying dividends even after Lehman. So I think we need banks to have the capital to support the credit needs of the economy. More generally, I'd say in the United States, I've grown concerned about what's happening with the Fed's stress testing regime. There have been a series of changes that, when you put all of them together, have made those stress tests less of a regulatory constraint. In the most recent tests, based on a completely outdated pre-pandemic scenario, the Fed conducted some analysis taking the pandemic into account, but it then released only aggregate results and not individual bank results. And to my mind, that undercut an important purpose of stress tests in a crisis, which is that by providing detailed information on particular banks, it forces those banks with shortfalls to take immediate actions, including capital raising actions. I think the Fed could have deferred releasing the results for a few weeks while updating the analysis, and they still could conduct updated analysis in the coming weeks. So those are some thoughts on banks. You asked me also to turn to the other small matter of I'll call it the shadow banking sector, although I think it's been given a new name. I still think of it as the shadow banking sector. And I would say it has not performed well in the face of the shock. And this reflects the fact that much less was done to address risks there after the financial crisis. And I consider that an unfinished agenda. So the Fed did an extraordinary job, as Ben and Augustine described, in dealing with the financial market fallout. But I think it's sobering that Fed intervention on that scale, which is utterly unprecedented, was necessary to keep credit markets functioning. As Ben mentioned, Treasury markets became completely dysfunctional in mid-March. That partly reflected pressures resulting from margin calls on some enormously levered hedge funds that were pursuing relative value strategies. They were undertaking huge basis trades in the Treasury and Treasury futures market. I think we could easily have seen another long-term capital management type episode absent Fed intervention, first in the repo market and then to buy huge quantities. I mean, $2 trillion of purchases of treasuries in just a few weeks really is an eye-popping intervention. Now, risks relating to hedge fund leverage were identified as a financial stability risk by the Financial Stability Oversight Council in 2016, but they were never addressed. That risk was never addressed. I think FSOC's failure to address this issue largely reflects the focus on deregulation during the Trump administration, but it also reflects the fact that the Financial Stability Oversight Council in Dodd-Frank was really given no tools other really than designation of individual companies and financial market utilities. It was really given no tools to address activities that create financial stability risks. Also, Congress never established a systemic risk mandate for the SEC or other agencies in Dodd-Frank. And that makes it questionable what actions the SEC would have been willing to take to address hedge fund risks, even if FSOC had continued to pursue it. The SEC did put into place some rather modest money market fund reforms after the financial crisis that took a lot of prodding from FSOC, and those reforms look not to have worked. We saw huge outflows from both prime and municipal money market funds, including those that had adopted floating net asset values. And that required the Fed to stand up facilities enabling the funds to offload assets without fire saling them. And since the outflows threatened a drying up of demand for commercial paper, the Fed also put the commercial paper facility back in place. It's very fortunate that they were able to pull the term sheets out of the drawer that Ben and others had created back after the financial crisis. The SEC reforms that were adopted in 2012 for money market funds allowed individual funds to put in place gates and fees once liquidity fell below a minimum level. Most economists thought those gates and fees would be destabilizing, and I believe that was exactly the case. There were also, as Augustine and Ben mentioned, stresses in corporate debt markets. Well, again, FSOC recognized that open-end mutual funds offering daily liquidity but holding less liquid assets were run-prone. So that was a financial stability risk that was identified. And absolutely, those funds, corporate bond and leverage loan funds, suffered significant outflows in March. None failed. We didn't see enormous fire sales of corporate debt, but the Fed's announcement that we would set up the primary and secondary corporate lending facilities and that it would buy corporate bond ETFs, including some high yield ETFs, undoubtedly helped stem those outflows. So I'd finally mention one last thing. Almost every major financial stability report in recent years has pointed to high levels of non-financial corporate debt as a development that would likely exacerbate the severity of the next downturn, whatever happened to cause it, because firms with large debt overhangs tend to restrict hiring and investment, and there could be a wave of bankruptcies. And I worry that the failure of regulators to address that buildup will likely mean that economic recovery is going to be more difficult. We're already seeing lots of corporate debt downgrades and defaults. Well, during the time that I was at the Fed, I will say that we saw that leverage lending was surging, and we observed underwriting standards deteriorating. It was a risk that I certainly thought it was appropriate to address. What we did, and it's really the most we thought possible from a regulatory standpoint, was to issue supervisory guidance about underwriting standards. And I guess at the end of the day, it was largely ineffective, and there was serious pushback from Congress that the Fed and other banking regulators had overstepped our appropriate bounds. So let me just conclude by saying that for me, these observations reinforce the importance of addressing long recognized shadow banking risks and asking Congress to create authority for regulators to apply cyclical macroprudential tools to address emerging financial stability risks. As Augustine pointed out, and I absolutely agree, we're likely to be in a world of low interest rates for a long time to come. And given that that can incent risk-taking behavior that creates these risks, I think it's all the more important. So let me stop there.
Thank you very much, Janet. I appreciate it. So I want to apologize to some people who I understand there was some trouble joining the live stream. So my apologies on that. But I know that everybody's been, I think these troubles have been solved. So that at least you got to hear the last few speakers. And now we have some questions, and I wanted to pass some of these questions along on a parcel them out to different panelists. And the first question I'd like to ask is to Augustine. So you're on the spot now, so you're being cold called. And this is a question from Martin Rodrado. And Martin asks, this crisis has renewed the problem of currency mismatch in emerging markets. This time it is not in the balance sheet of borrowers, but it has hit investors in local currency bonds. As policymakers, should we put in place prudential regulation to limit the exposure of foreign investors in local currency instruments? You have thoughts on that?
Well, I share his point of view. Over probably 20 years ago, Ricardo Hausmann and I think Barry Eichengreen came with this concept of the original sin, which was that some emerging markets could not borrow in their own currency, and so they would borrow in foreign currency, and then they would get the currency mismatch, and that would hit them drastically. Now the problem is exactly as he said, that well, not only, but to a large extent, is that as a result of the original response to the original sin, emerging markets devoted themselves to enlarge and modernize their domestic sovereign bond market. and that attracted huge amounts of investment. And the expectation was that this was going to be a source of stability, no? Because you know, as a local issuer, you don't have the mismatch. But in times of a crisis, it becomes to some extent a double whammy, because precisely not only in times of crisis, interest rates go up, and a lot of these institutional investors have been investing in very long-term bonds in emerging markets. So the price sensibility to interest rates is huge, but also they have the currency aspect. So a large part of the capital outflows that we have seen responds to some extent to this double whammy. I don't necessarily think that this is a matter of regulatory supervision. I think the most important funds are very large institutional investors. It's more a matter of them exposing themselves to risky assets, and I think it will be very difficult to manage this exposure through regulatory action. Lastly, and just to say where the original sin has not disappeared, and I think Janet made some comment to this, is in corporate debt. Emerging market corporate debt, external corporate debt has grown dramatically. And there we really have an issue, and that really can exercise a depressive pressure in the future.
Thank you very much, Augustine. The next question comes from my Yale colleague, Bill English. Bill is now on the faculty at Yale with me. And before that, of course, he worked for both Ben and Janet at the Federal Reserve in senior roles. And he is taking this opportunity with you on the hot seat to turn the tables and ask you a question.
Okay.
And Bill's question is, I would be interested to hear Ben and Janet's views on whether permanently higher debt to GDP is a problem. With low interest rates, it isn't obvious. Tarman was worried about a loss of confidence, but is that an issue for countries borrowing in their own currency and with their own central bank? So who wants to go first and answer their former employee?
You want me to, I'll start off maybe with a few remarks and Ben can pick up. So Tarman expressed great concern about the increase in debt to GDP ratios, and it seems to think it's a priority to get them down to something close to former levels. I am less concerned about it. I think because, while there are clearly risks, we don't know for sure what the interest rate environment is going to be in the future. But I think most economists at this point are envisioning a future, for the foreseeable future, secular stagnation is the problem we're going to be dealing with, that we're going to be in a world of chronically low interest rates. And that means that the interest burden on the debt is very low. I mean, just to give an example, between 2007 and just before the pandemic, the US debt to GDP ratio doubled from roughly 40% to roughly 80%. And the interest on the debt as a share of GDP was absolutely flat or edged down just a speck. And it really hasn't proven a problem. And I think if we have a large fiscal response, as I believe we should, to the pandemic, and the US debt to GDP ratio moves up in line with, say, CBO projections, maybe goes up to around 110%. In the interest rate environment, I'm assuming, I really don't think this is going to be a major problem. You could look at Japan and lose a huge amount of sleep. Here's a country with basically a 250% debt to GDP ratio. And yet, even in Japan, are there risks that one day interest rates in Japan will shoot up? Sure, we don't really know what's going to happen, but it hasn't really proven to be a problem. What I worried about well before the pandemic for the last easily 20 years and continue to worry about, I'm not so worried about our debt to GDP ratio goes from 80 to 120 or something like that. What worries me is that we do not have a fiscal deficit that is sustainable. So US debt to GDP ratio wouldn't just stabilize at 110 or 120%. And this is due to a problem that we have known about for 30, 40 years, which is we have an aging population. We have the share of US GDP going to Social Security, Medicare, and Medicaid that's rising. And unless we change something significant along that path, which we have not been willing to do, during my professional life, the debt to GDP ratio is not going to stop at 110 or 120. It's going to continue to skyrocket, and that's not okay in my view.
Thank you. And you have something to add.
I would I would support the two main points that in the near term, we'd like to see interest rates higher rather than lower. And so the current level is not so much concern, and the worry about sustainability. I would add, from a political economy point of view, if debt is free, there's strong temptations to use resources wastefully. I mean, I think it's still important that our national resources be prioritized and used in an efficient way, in a way that's consistent with increased equality, that's better growth, R&D, education. You want to use our resources effectively. And from a political economy point of view, one of the risks of saying that debt is never costly is precisely that there won't be any kind of sense of the trade-offs. There's still real trade-offs in terms of the use of national resources.
Thank you. We have a variety of questions around a specific theme, which is one that I'm sure all of you have been asked a lot over the last couple of months, which is, why is the stock market doing so well? Why is the stock market doing so well? Credit markets seem to be fine. We have new issues doing okay, but a lot of us are worried about what's going to happen in bad downside scenarios. How do we reconcile that? Do we, we don't like to say that the markets are crazy. That's not in our professional DNA. But does there seem to be, to you, any kind of disconnect? So I'm throwing that out there. I'm going to put somebody on the spot. Otherwise, you're going to end up with my answer. What do you think, Augustine? You go first.
Well, I think some fair amount of differentiation is happening. If we see, for example, NASDAQ is doing extraordinarily well, and I think their technology is really picking up. And I think that this crisis have accelerated many structural changes, taking advantage of technology. Just the fact that we're meeting in this format is testimony that this has some validity. But at the end of the day, there is a real problem of where to channel some resources. An issue that we have been struggling for a while is, for example, the long-term obligations of some different forms of financial intermediation. Insurance companies, pension funds, search for yield is still there. I think that this is an issue that as we move forward will become more and more urgent. Something will have to happen. I don't know exactly what, because at the end, it's this thing of balancing short-term needs versus long-term issues. Prudence would be advisable. But then again, there is this issue that some financial intermediation requires some form of returns, and I think that lends themselves into this disassociation, at least in the short term, between economic performance and stock markets. And I think to some extent the markets feel a little bit uncomfortable. And precisely this last month or so, we have seen, even though a lot of pickup in some stock markets, we still see a lot of volatility. And that is that the belief that the recovery is here and it will last is still not there. So hopefully at some point this will correct itself. Growth will be of the essence, but it's a challenge moving forward.
Thank you, Augustine. Ben, I'm going to turn to you next because I know everybody is asking you this. You're probably really happy that you don't have to go into the office and get asked by everybody on the street why the markets seem to be dissociated from the economy. But we got you here on Zoom. Does it seem to you that the stock market and the economy in the United States are not talking to each other?
Well, of course, it's a fool's game, to predict the stock market. You could rationalize the stock market, I think, in the following way, if you want. One is that the risk premium, the equity risk premium, which spiked up in March, is now back down to more normal levels, or maybe even a little bit lower than normal, number one. Number two, interest rates are low and expected to remain low. And importantly, third, I think the markets are assuming that through a vaccine or some other intervention, that the effects of the pandemic on profits, and of course, what matters for the stock market is profits, not median income, is going to be temporary, and therefore, with low interest rates, even a fairly sharp decline is not going to have such a big effect on prices. So I think that's kind of the story, and I think that's why the market is very sensitive to. We've seen it be very sensitive to health-related news, because I think the main risk to the market would be that the pandemic and the associated economic effects are going to be deeper and longer than the market currently seems to think.
That makes sense. Thank you. Janet, I know you're getting the same question from all of your relatives.
I am. I don't have a lot to add to what Augustine and Ben said. I think low interest rates are an important contributor to the valuations we're seeing. And I agree very much with Ben. I think the market is looking at the longer term profit picture and assuming that a vaccine will come along and that we'll be out of this, and this is a temporary situation. I must say, though, I'm more concerned with a long-lasting economic downturn than I think is built into the market. I'm concerned that this is doing sufficient damage and creating so much scarring before we get that vaccine, and the government's ability to support incomes once the economy begins to recover, that we could end up with a very prolonged recovery. So I wouldn't automatically say I agree with the market, but I think those are the things markets are factoring in.
Thank you. Actually, I want to follow up with a specific question for you, which is itself a follow-up to your your initial talk. And this is a question from Dick Berner. And Dick Berner was the first and founding director of the Office of Financial Research.
Of course.
And he is responding to the concern that you have about gaps. And he asks, what authorities should regulators have to limit the buildup of excessive non-financial leverage? So what could we do, and what authorities would we give that would enable that if we were worried about it to limit it? Do you have thoughts or proposals?
I don't have a detailed proposal, but I would say that I believe FSOC needs to be reconstituted and to be given a set of tools to address activities like the ones I mentioned that create financial risks. In cases where there are regulators, say of hedge funds or open-end mutual funds like the SEC, I believe there needs to be a clear financial stability mandate that the SEC is obligated to take steps, possibly those recommended by FSOC, to address financial stability risks. And the SEC simply does not have any such mandate. I think even in the case of money market reform, a view among many of the commissioners was, well, we really can't do that. That's not for systemic risk reasons. You know, you could really justify what they did maybe on investor protection grounds, which is their mandate. But so I think the SEC could have taken steps if they had been given a financial stability mandate. But look, imposing limits on underwriting practices. It could be the most common thing is housing. I don't believe the Fed or the banking regulators have currently the ability to impose caps on loan to value or debt to income ratios in borrowing unless it's an issue of safety and soundness. I don't think they could do it because house prices are booming and they're worried about broader financial stability risks. And I think the Fed could be given that power, FSOC could be given that power, and it could apply also beyond housing, which many, many countries have and have used that as a cyclical macroprudential tool. I think similar powers could be given with respect to corporate borrowing and other commercial real estate, another area where we've seen excesses.
Thank you. All right, Mr. Berner, I think that is a pretty complete answer. So I think you got an answer there. We have a lot of excellent questions that we have not been able to answer, and we're almost out of time. So what I wanted to do actually in the last 2 minutes we have here is there's 2 questions that I see on here, which I think answer each other. And so I thought I would just read them and say that and let our panelists off the hook. So there is a question from Wilson Irvin, and Wilson has a set of excellent questions that he has on here. And specifically, one of the questions from Wilson is, I'd like to ask about a downside economic scenario. Let's assume a tough recession, a W or a U-shaped recovery with significant credit losses that creates challenges for banks, including solvency threats. What do you think is the likely policy response in the US and for other countries? Would you expect TARP 2, a private capital solution, or something different? And I think that's an excellent question. We don't really know. We know, of course, that the politics of any of those things would be complicated. But then there is another question down below from an anonymous attendee. Somebody who doesn't want to give their name and asks, Janet argued that not halting dividends now is a mistake. Dividends today are very small in comparison to the large new capital stack that she and Ben helped build over the last decade. They are also small in comparison to TLAC if things go bad. Paying dividends for the second half of 2020 only changes capital for the GSIBs from 1 trillion to 1.0 trillion. Why would that matter? I think that Wilson's question answers the anonymous attendee's question, which is it's not about the $20 billion that we will save in dividends. It's about the extremely complicated political economy problem that we will have if we end up needing some kind of government support for the banks. And I do not think that Ben or Janet or any of their successors would want to go to Capitol Hill and testify, yes, I think it would be great for us to do a TARP 2. No, I thought it was fine for the banks to pay dividends a few months ago. So I think that is the concern. And so I'd like to be able to get to many of the other questions. Luckily, those 2 questions addressed each other. So now I can say thank you very much to our panelists and to all of our participants. I appreciate people taking the time And good luck to everybody, and stay safe. Thank you.
And bye-bye.
Bye-bye.
Bye.